Crypto products and NFTs are unregulated and can be highly risky. There may be no regulatory recourse for any loss from such transactions.
Welcome to ET Markets Crypto TV presented by CoinSwitch Kuber. There are thousands of crypto in circulation now. Some estimates say over 15,000. How do you pick a good one? Something that does not wipe you out. Before anything, please know cryptos are extremely volatile and also they're very heavily taxed. Every expert will tell you that put your money in it only if you have no qualms about losing it. Now, if after this you're still here and you're curious to know how you should be evaluating a crypto, then this show is for you. I'm Meloni Bhatt and I have with me Rohas Nagpal. He's the author of Future Money Playbook and Chief Blockchain Architect at the Wrapped Asset Project. He's also an amateur boxer and a retired hacker. Rohas, welcome.
Thank you for inviting me.
Now, first of all, this is some information for our audience. We know that crypto are digital assets supported by a technology known as blockchain. Blockchain is tamper-resistant record of transactions that keeps track of who owns what. Public blockchains, say like Bitcoin and Ethereum, are usually decentralized, which means they operate without a central authority such as a bank or a government. Now, this is the basic. So, Rohas, back to you. What are the pointers one should look at to evaluate a crypto?
Sure. So just remember my name, ROHAS, and I've built a simple system around it. Whenever you're evaluating a crypto, R stands for revenue, O for organization, H for history, A for algorithm, and S for social platforms and engagement. So R means we look at the revenue model and the economic ecosystem that the crypto is trying to build, because it's ultimately a financial asset. It has to add some economic value. Then we look at the O for organization. What's the team behind it? So, you can look up the founders on LinkedIn and see what they've done in the past, and it should be a strong organization. H for history stands for history of the project, of the founders, and of the crypto itself. How has its liquidity been? What are the different kinds of trading pairs? What is the market cap? All that we examine. A is for the algorithm, where we look at the technology stack of how the crypto is built and whether technologically it is strong. And S for the social following. So look up all the different platforms like Twitter and see how large the following is and whether that's a large positive community and a good number of fanatics who are really crazy about the project. So that's how I would recommend you look at a crypto project.
Okay, but say a lay investor may not understand the A part of it, the algorithm. How do I know that this is something I can trust? This is something that's going to work, something that will grow in value?
So one way of looking at the tech stack is, even if you Google, you will come to know whether there have been successful attacks on that crypto. Like Solana recently went through a lot of attacks, and that's easily available to us. Also have a look at their GitHub repository, see the number of forks or stars, how many people are following that. And also, most crypto projects, they undergo auditing from third-party auditors. So that information would be available on their website. So make sure it's being regularly audited. Using this, you'll be able to get the tech stack also pretty well.
Okay, so if you look at all of these pointers, how do you explain the high market cap and the allure of meme coins, like say Dogecoin, something that does not even make a pretense of being usable in financial transactions? There's no constraint on the supply of these coins, so their prices, they surge or crash on random events, such as tweets from Elon Musk. So would Rohas' formula apply here as well?
Actually, it applies there also. And in fact, I'd like to tell you, even though I'm personally not a fan of Dogecoin, it actually has so many stores around the world which are accepting Dogecoin. And Elon Musk's tweets are never random. It is all very well timed to manipulate the prices up and down. I mean, I'm sorry to say this, but that's a fact. Almost all the manipulation that happens is extremely well planned. And after a certain period of time, you can start to analyze and understand when the next zoom or crash is going to come. And it's fairly predictable and obvious now.
What if I'm an investor wanting to invest? I've heard only of Bitcoin and Ether, and I don't have the bandwidth and the capacity to analyze a coin as per your method. Does it mean that I should not bother with crypto at all?
Excellent question. So I would say if you're just starting, start with a zero budget. And there are three ways of getting free cryptos. So those three ways, firstly is an airdrop. So every new crypto project gives you free cryptos to as a marketing strategy. Apply for the free airdrops. So there are sites like Airdrop Alert and CoinMarketCap which give you a list of the latest airdrop. Absolutely free. Second is something called Learn and Earn. Watch a video, answer a quiz, get free crypto. That's the second way to do it. And the third is play to earn games. So there are lots of these new blockchain games where you play the game and you get free crypto. So I would say if you're new, don't invest a single rupee or dollar. Start with the free cryptos. Then go to the next level. Say I have $100 to go. Then go for Bitcoin. That's the big daddy. Everything depends on Bitcoin prices. When Bitcoin goes up, the market goes up. When Bitcoin comes down, the market comes down. So if you're $100 player, start with Bitcoin. If you want to go to the next level of $1,000, then I would say go with the big guys. That's Bitcoin, Ethereum, and Binance. These are the three big ones. And then if you're going beyond that, that's when you need to do a little more analysis. And then you could choose to go for sectors like the decentralized finance sector, the gaming and metaverse sector, and these are usually the ones that are quite popular nowadays. So then you could go by sector if you're $1,000 and above.
Okay, so start with free and then go on. But all experts tell you that don't put in a rupee if you're not willing to lose at all. Do you stand by that?
Unfortunately, yes, because it is volatile and it's a very new asset class which is barely a few years old. I personally only invest in two things, real estate and crypto. I do not understand anything else other than these two. So in my case, my crypto investment may be a lot higher than what other people have. But yes, you must understand your risk appetite and your risk tolerance level. So cryptos is a very wild ride, extremely volatile. And yes, it's possible that they may all crash to zero. So you have to be prepared for that.
So this is essentially a self-monitoring, a self-policing system for the investor. How does an investor ensure that they don't lose money? What are the warning signs to look for?
So I think one of the, the best things is to look at something called the crypto fear and greed index. So when that comes very low, it's extreme fear in the market, that's the perfect time to buy. And when it goes up, which is extreme greed, that's the perfect time to sell. And this is a strategy actually even Warren Buffett has followed all his life. That when everybody is buying, you sell. When everybody is selling, you buy. And like I said, for the crypto market, that's fairly easy to guess.
Unlike stock markets, crypto projects don't have financial statements to analyze. Yes, you've shown us the Rohas method, but how do I look for stability within the project?
Yes, there is. So when it comes to decentralized finance or DeFi projects, the most important metric is called TVL, total value locked. That's the total amount of assets locked into that particular protocol or platform, and that is used to generate revenue and cash flows. So TVL is one very good option. If it is a non-DeFi kind of a thing, then look at market capitalization, which is similar to what's in the stock market. And usually I find projects which are a billion and upwards, billions of $1 billion and upwards in terms of market cap are better to invest in. So that's another very good metric that you could look at. And the third, if you're looking at a currency kind of a crypto, then look at the volume, which represents how much of that crypto has changed hands in the last 24 hours. That's a very good indicator. So to summarize, for DeFi, look at the TVL or total value locked. For the currency kind of ones, look at the volume. And for others, look at the market capitalization.
Is scarcity a pointer of value? For instance, we know that there is a finite supply of Bitcoin, 21 million, and 19 million odd are in circulation. Supply is inelastic, demand is high. Same with NFTs. The rarer the token, the higher the value.
I would definitely go with that logic. And in fact, it applies to everything, including real estate, gold. Everything is more valuable if it's scarce. Yep. So one very important thing when we talk about scarcity, Bitcoin and certain cryptos come with a fixed maximum amount. So we know it's fixed at 21 million. But there are some good projects like Ethereum, which are actually unlimited. But the team behind it is managing the numbers well. So even though it potentially could be unlimited in terms of number of coins, it is reasonably scarce. So while scarcity is important, we've got to factor in other issues also. Like one of the coins I mentioned is Binance. When they started, there were 200 million coins, and they announced right on day one, every quarter or 3 months, we are going to burn a certain number of coins till there are only 100 million left. And
burn means?
Yes, they destroy them. kind of like when you look at the stock market, you have a concept called buyback of shares. When a company buys its own shares back and has to destroy them. Similarly, in the crypto world, we call it burning. So a Binance is actually very aggressive on scarcity. So that's a good thing for it. And Ethereum can be unlimited, but they're managing it well. So it's still really good. And a Bitcoin, of course, is fixed. It cannot have more than 21 million.
You said earlier that as one starts out into crypto, go for the free coins through airdrop or by playing games. At what point should I give them up? Why should I be holding on to them? Yes, because they're free. But at what point should one say, this is not worth it?
So that's an extremely interesting question. So the reason that I want you to go for different airdrops is because then you will learn how to handle different cryptos, because you will need different wallets. All cryptos will not come in the same wallet. So that increases your knowledge of, the basics of how to take care of it. Other than that, if you feel that the project is really good, then hold on to the free cryptos for a longer period. But if you feel it's nothing great, then the moment it's listed on the crypto exchanges, you can just exit and make a little bit of money. Or you could maybe sell off half and just forget about the half. Because what if the project really becomes great in future? You shouldn't feel bad. So you can always park half and just sell half the moment it lists on the exchange.
There's an estimate, that there are 15,000 of crypto. How many of these are listed on the exchanges? 100, 200? What about the rest of them?
So actually in the crypto world, there are two kinds of exchanges. There are centralized and decentralized. Centralized are the ones we hear about, and they do KYC and other things, and you connect your bank account to them. There the number of coins listed is lesser. Decentralized is where anybody in the world can go and they can create liquidity pools. So for each blockchain, there are decentralized exchanges. Like for an Ethereum, there would be a Uniswap. For Binance, there would be a PancakeSwap, etc. There the number of coins is actually very, very large. And then there are platforms like Trust Wallet, where are more than 100,000 crypto assets are available. So you can look for cryptos in different places. As of today, there are about 17,000 plus cryptos. But I would say actively, maybe just about 50 to 100 are really being traded. Personally, I follow about 50 of them only.
So I wanted to talk about stability. 17,000 of crypto, 50, 100 are worth following. How do I measure the stability? Is it on how long the project has been going on, or how long the crypto has been traded? Is that the right metric?
No, the time is not so critical. Although, of course, older cryptos, it's a good thing. But like I said, I would look at metrics. So if it's DeFi, I would look at the total value locked. And then there are formulae which we have devised. So for example, there is market capitalization divided by total value locked. And then in DeFi, I believe 3 is the golden ratio. And Ethereum is always close to 3. And if you're above it, you're overvalued. Below it, you're undervalued. Just like in the stock market world, you have earning per share and P by E ratio. So very similar to P by E ratio would be the MCAP to TVL. So like this, there are formulae available. And it's important for investors to learn and understand these formulae before you put your money in, which is why I said start with the free ones, then go to Bitcoin, then go to the big three. Then once you've learned a lot, then you can start dabbling into the other sectors. But for that, you should learn these metrics.
Can you tell us a little bit about stable coins, which are pegged to the value of the various government issued currencies or assets, such as gold? Why are stable coins important? What can you do with them?
They're extremely important, and sometimes they're the best investment. So for example, if you feel the markets are very volatile right now and you want to exit, but if you move your money from the crypto exchange to your bank, there's going to be some charges. So sorry. When you move money from the crypto exchange to your bank, there would be a lot of charges that you would incur. So what you do is on the crypto market itself, you liquidate your crypto and convert it to a stable coin like USDT Tether. And then the beauty is you can invest the Tether in a deposit. And as of today, you would get about 14% per annum as a rate of interest. So now, as an Indian, I know that the dollar versus the rupee, anyway, every year the dollar goes up. So not only am I benefiting from the increase in the dollar rupee ratio, and I'm able to get 14% rate of return by depositing my Tether with a crypto exchange, and they give me interest. So I think stable coins are a very important part of your strategy. And whenever you feel that currently the markets are too volatile for you, exit, liquidate your cryptos, convert them to stable coins, hold them on an exchange in a deposit, and then whenever you want to enter back, that's when you again buy the crypto. because moving it to your bank and moving it back is a big friction. So that's where stable coins fit in.
So what about GameFi and gaming tokens? Why are they important? What drives their value?
So gaming and metaverse, I usually prefer to club them together. And a lot of people around the world like to play games. And for them, blockchain-based games gives an added advantage that you actually get paid to play the game, which is not what happens in the normal world of gaming. And another very big important thing is, in a normal game, whenever you earn assets, like maybe weapons or cars or whatever, you don't actually own them. You can't sell them. You can just use them in the game. But in the blockchain world of games, every time you earn these assets, they are NFTs, non-fungible tokens, and you can go on the exchanges and sell them also. So your game actually becomes a way for you to earn money. And that is why games, tokens and cryptos are doing very well. So some of the good ones are Gala Games, Engine Coin, Decentraland, Sandbox. These are some of the really good popular ones.
Governments want to control on crypto. They want to regulate it, they want to tax it, and the need for regulation and through it control is being echoed by those within the crypto ecosystem. The paradox here is that the core idea of crypto was individual autonomy and freedom from government and institutional control. So how will regulation and the idea of autonomy, decentralization, etc., play out in the long term?
I feel this concept of not being regulated is fine for Bitcoin and a few of the other cryptos that are used as currencies, because they're not supposed to be governed by the government. That was the whole logic. But cryptos are of 11 different categories and currencies is just one part of it. So when we look at the other projects, so I also have my own crypto project that I run. We are actually for regulation because we are trying to do real world businesses. And I would say most of the platforms out there would actually benefit by way of regulation, and we'd be able to do things much easier. And a lot of jurisdictions around the world, including the US state of Wyoming or the Middle East, or now even in India, the Gift City at Gandhinagar, which is India's first IFSC, they are actually very positive towards this. So I would say regulation would actually benefit almost all the crypto projects, and the only crypto projects that don't want regulation or don't need it would be a few projects like, say, a Bitcoin, Litecoin, Bitcoin Cash, Monero. These 4 or 5 which are hardcore currency-based projects. Other than that, everything would benefit from regulation. That's my opinion.
Rohas, thanks so very much for your time and for explaining to us how to evaluate different cryptos.
Thanks for inviting me. Bye-bye.
Once again, we want to remind everyone that crypto is unregulated. Be prepared to lose every paise. Only bother with it if you have the ability to manage the risks. It's a wrap from us. I'm Iloni Bhatt, and I'll see you soon.
Crypto products and NFTs are unregulated and can be highly risky. There may be no regulatory recourse for any loss from such transactions.